Imagine you're standing right in the center of Beijing Capital International Airport.
Oh, yeah. Massive place.
Just absolutely massive, right? And you're just watching, thousands of people moving through security, checking their bags, staring up at those huge departure screens, scanning digital boarding passes.
Right. The sheer volume of human movement is just staggering.
Exactly. And behind every single one of those actions, from the exact moment a traveler taps buy on an app to the moment an airline settles a cross-border payment for a code-share flight, there's this invisible digital nervous system that's just dictating the entire flow.
Yeah, people usually just think of aviation infrastructure as, concrete runways and radar towers.
Right. But the reality is that the most critical infrastructure in modern travel is, it's code. And in China, almost all of that code belongs to one single entity.
Which is pretty wild to think about.
It really is. So welcome to the Deep Dive. Today, we are unpacking the operational and financial architecture of TravelSky Technology Limited. That's ticker 0696 on the Hong Kong Exchange.
And it's an incredibly unique business model for us to dissect today, because TravelSky, they function as the mandated IT backbone for China's civil aviation industry.
The national team, basically.
Exactly. We're looking at a company that processes data for hundreds of millions of passengers. They settle billions of transactions, yet they remain almost entirely invisible to the end consumer.
You never see a TravelSky logo on your ticket.
Never. And we have a really robust stack of data to get through today. Primarily, we're pulling from their FY 2025 annual report, the 2025 interim results, and some aggregated market and sentiment data running right up to July 2026.
Okay, let's unpack this. But before we get into the actual mechanics of how this company effectively acts as this central toll booth for an entire nation's travel economy, we do need to lay down our standard disclaimer for you.
Right, very important.
Yeah. We are analyzing public financial documents and market data strictly for educational and entertainment purposes. We are not financial advisors. This is not investment research, and it is certainly not a solicitation to buy or sell any security.
No, definitely not.
So you always have to do your own due diligence, verify the primary filings yourself, and consult a professional. Because, as always, investing carries the very real risk of capital loss.
And that is a vital baseline for you to remember, especially when we're analyzing state-backed infrastructure plays like this one.
Right.
Because they carry their own completely unique set of macroeconomic variables and, governance structures.
Yeah, the rules of the game are just a bit different here. So let's get right into those mechanics. Part one, the business analysis. When you look at TravelSky's FY 2025 revenue breakdown, you immediately see how deeply embedded they are.
Oh, they're everywhere in the stack.
Right. They aren't just selling some, single sauce product. They are operating a massive 5-pillared ecosystem. And the foundation of that ecosystem, which generates about 52.7% of their total revenue.
Which was roughly 4.6 billion RMB in 2025, just for context.
Right, 4.6 billion. That is their aviation information platform services. This is the core engine, right?
Yeah, exactly. This is the electronic travel distribution, the computer reservation system, the inventory control, all the really heavy lifting.
And it grew a pretty modest 2%. But that growth was driven entirely by volume.
Right.
I mean, they don't have to constantly hike subscription fees or, upsell new software modules to squeeze out that growth. They literally just sit back and collect a toll on the sheer volume of human movement. It's the core toll booth on the highway of the sky.
I like that analogy. And that volume, it's just staggering. In 2025 alone, they processed data for 767 million passengers.
Wow, 767 million.
Yeah. To put that in perspective, that platform is constantly, every second, updating seat inventories, syncing departure control protocols across physical gates, and managing the reservation state for 41 Chinese airlines.
And not just domestic, right?
No, plus over 400 foreign and regional carriers. So when revenue is tied that directly to total processing volume, the company's top-line health just becomes this pure derivative of macroeconomic mobility.
So that 2% bump we saw.
Right. That wasn't some masterclass in aggressive sales tactics. It was simply the residual momentum of post-pandemic travel normalization. More people flying equals more tolls collected.
The toll booth just scales infinitely. But, the platform service is really just routing the people.
Yeah.
The segment that I find fundamentally more interesting is how they route the money.
Oh, the clearinghouse, yes.
Yeah, the accounting, settlement, and clearing services segment. So this makes up about 10% of their revenue, bringing in around 875 million RMB, and that part actually grew at an 8.4% clip.
Which is a very healthy growth rate for settlement.
Definitely.
Yeah.
And through their subsidiary, ACCA, they are operating as the world's largest processor of the International Air Transport Association's billing and settlement plan, the BSP.
Right, the BSP. And the complexity of that clearinghouse function, I really mean this, it cannot be overstated.
How does it actually work in practice?
Okay, so think about it like this. Say a travel agent in London books a multi-leg cross-alliance itinerary for a corporate client. They fly, say, British Airways to Dubai, then Emirates over to Beijing, and then they hop on China Eastern to some secondary domestic hub.
Got it. Sounds like a nightmare to expense.
Exactly. And the travel agent just collects a single lump sum from the client. The BSP is the underlying ledger that untangles that single payment.
Right.
It calculates all the fractional currency conversions. It accounts for disparate tax jurisdictions. It extracts the agency commissions. Yeah, and it ensures every single carrier gets their exact micro slice of the pie.
And TravelSky is the singular funnel for all of that within the massive Chinese market.
Completely. They processed 1.3 billion settlement transactions in 2025.
Billion with a B.
Yeah. clearing over 73 billion RMB in agency cargo and clearing fees. They are effectively the central bank of Chinese aviation data.
The central bank of aviation data. That's a great way to put it.
Yeah.
But looking at the source documents, the picture isn't entirely flawless when you scan down the revenue lines.
No, there's definitely a sore spot there.
Yeah, the airport digitalization services segment. So this makes up 17.1% of the business, but it took a massive 20.8% hit, dropping down to about 1.5 billion RMB.
Yeah.
Wait, a 20% drop? Sounds terrifying. Is their tech becoming obsolete? My immediate assumption when I see a 20% drop in an enterprise IT segment is, structural decay.
Of course.
You think, okay, municipalities are out of cash, airport upgrade budgets are slashed, or worse, they're just losing ground to competitors.
It's the logical reflex for sure. But the source material clarifies that the project-based accounting structure of this specific segment paints a very different reality.
Oh, so?
Well, the first two segments we talked about, ticketing and settlement, those are transactional. Revenue is recognized continuously, millimeter by millimeter, as tickets are booked.
Right, a ticket is bought, a few cents drop into the bucket.
Exactly. But airport digitalization is entirely different. This involves really heavy, multi-year physical integration.
Like hardware stuff.
Yeah, hardware. We are talking about deploying physical facial recognition stations at departure gates, building out 5G private networks across massive terminal complexes, overhauling legacy baggage handling systems.
Okay, so you can't recognize the bulk of a, say, 500 million RMB contract until the final servers are actually racked, the hardware is validated, and the airport authority actually signs off on those acceptance milestones.
Precisely. The 20.8% decline in 2025 is just a timing artifact of those milestones.
Oh,
They simply had fewer mega projects crossing the final finish line and tracing that revenue recognition in the 2025 calendar year compared to 2024.
So they didn't lose the business.
No. The underlying contracts are still totally intact. The engineers are out there still laying fiber, but the accounting calendar just makes the cash flow look a little lumpy.
I see. It's basically the classic home builder dynamic.
Oh, that's a good comparison.
Right. If you hand over the keys to 10 finished homes one year and only 5 the next, because the others are still undergoing final inspections, your top line looks abysmal, even if your backlog is actually stronger than ever.
Exactly.
But that does introduce a really tangible metric for us to watch. I mean, if we roll into FY 2026 and that segment drops another 20%, we can no longer just blame project timing.
No, definitely not. At that point, it transitions from a recognized accounting quirk to a legitimate demand-side contraction.
Which is exactly why vigilant due diligence requires tracking segment performance across a 3 to 5 year horizon.
Right.
Rather than just panicking over a single 12-month snapshot.
Absolutely. You really have to contextualize the hardware delays with their software advancements. Because while the physical digitalization revenue was deferred, their fourth segment, which is aviation travel intelligent products, that actually grew by nearly 19%.
Up to 1.1 billion RMB.
Yep. This is where TravelSky is deploying their data intelligence and vertical AI integration.
And they're supporting all of this by reclaiming leased out server space, which brings us to the fifth segment.
Right, the information network and digital infrastructure segment.
Which was completely flat, down 0.3%. And the explicit reasoning provided in the report is that they reclaimed external server capacity for their own internal use.
Yeah, they stopped renting out servers so they could use them.
They are literally eating their own infrastructure to power these new intelligent product models. It really points to a company that knows its fundamental value is data gravity, and they are preparing the compute power to actually leverage it.
Let's focus on that concept of data gravity for a second, because I think it transitions perfectly into analyzing their economic moat, part 2.
Right, why they can't be copied.
Yeah.
Because if they're processing 1.3 billion transactions, someone else must want a piece of that pie. Why can't a competitor just build a better system?
Well, the sources rate their moat as wide and stable, and actually leaning toward widening internationally.
Okay, but why? Traditional moats in the software space are usually built on high switching costs or, network effects.
TravelSky enjoys both of those, definitely. But their primary defensive barrier is a structural, state-mandated monopoly. They are officially designated as the Critical Information Infrastructure Operator for Civil Aviation under the purview of SASIC.
Wait, SAS?
The State-Owned Asset Supervision and Administration Commission.
Got it. Okay, so usually when we look at corporate strategy, we look for companies that use counter-positioning to carve out a niche.
Right, that's the classic startup playbook.
Yeah, a nimble entrant figures out a new business model that the legacy incumbent just can't replicate without cannibalizing its own profits.
Could you define counter-positioning in this specific context?
Sure. What's fascinating here is that TravelSky completely flipped the script. Their counter-positioning is purely regulatory.
Oh, I see. Yeah, a foreign tech giant or some well-funded startup out of Shenzhen, they can't just code a superior database, build a slicker UI, and go pitch it to China Southern Airlines. It is a literal regulatory impossibility to displace the national team on core infrastructure.
So the barrier to entry isn't capital or having better engineering talent?
No, it's the law. To compete with TravelSky, a new entrant would have to successfully petition the central government to completely dismantle the foundational architecture of the nation's aviation security protocol.
Which is just not going to happen.
It's an insurmountable hurdle.
But, okay, let's play devil's advocate. Even if we strip away the legal monopoly for a thought experiment, let's pretend the market suddenly deregulated tomorrow. The operational switching costs alone are still terrifying.
Oh, absolutely.
TravelSky's backend, particularly systems like their international passenger revenue accounting, it isn't just some standalone app you log into. It is hardwired directly into the airline's SAP ERP environments.
And when a software provider achieves that level of deep ERP integration, they basically cease to be a vendor. They become part of the central nervous system.
You can't just unplug them.
No way. Ripping out a billing system that is inextricably linked to an airline's supply chain, their human resources, their treasury functions, that requires years of parallel testing, massive consulting fees, and just an agonizing tolerance for operational risk.
Plus, TravelSky brings 19 consecutive years of safe, uninterrupted operation to the table. 19 years.
That's the kicker. In the aviation sector, reliability is the ultimate currency. An airline executive is simply not going to risk stranding thousands of passengers and paralyzing multi-million-dollar daily settlements just to save, a fraction of a percent on a newer, untested software platform.
Right, and you combine that operational lock-in with these massive network effects. They have direct links to all the global distribution systems worldwide, 133 foreign airlines, and almost 3,000 agents.
The more players on the network, the more valuable the network is to everyone.
Exactly. The more airlines that list their inventory on TravelSky, the more valuable the platform becomes to travel agents. And then the more agents utilizing the platform, the more essential it is for airlines to be listed there. It's a totally impenetrable two-sided marketplace.
And don't forget the intangibles. They sit on 141 patents and enjoy preferential tax treatments as a 19-year national key software enterprise, which gives them a huge structural cost advantage that just scales beautifully across their fixed data center costs.
Okay, so we've established they have a deeply entrenched, legally protected monopoly with a wide moat. But that brings us to part 3. Growth drivers. Monopolies can get lazy, right? If you already capture virtually 100% of the domestic market and your revenue growth is primarily just tethered to the organic ebb and flow of passenger volume, how do they actually grow from here? Where does a monopoly go?
Well, you either sell new things to your captive audience or you find a brand new audience. And the primary growth strategy here is fairly balanced between existing customer expansion and a secondary international push.
Okay, so looking at their new products, they aren't just maintaining legacy mainframe architecture.
Not at all.
You mentioned their AI models earlier.
Yeah, the vertical AI large models. Specifically, the source highlights Kihang and Gongsheng Ruxing in their recent deployments. They also secured over a dozen new data governance contracts last year.
So they realize that holding the raw transactional data is really only step 1.
Right. The real margin expansion comes from refining that data. They're offering airlines predictive pricing models, dynamic route optimization, and really granular customer behavioral analytics.
It's the natural evolution up the value chain. But the growth vector that really blew my mind, the one that could fundamentally reshape the company's long-term total addressable market, is their foray into the low-altitude economy.
Oh, this is the most futuristic part of the whole report.
It sounds like pure science fiction, but it is already operational. The sources mention a manned-unmanned aerial vehicle cooperative system that was put into operation at the Xinjiang Shihezi and Yunnan Wenshan regional airports.
Yeah.
We are moving into an era where the airspace just above the treetops is going to be swarming with, autonomous delivery drones, infrastructure inspection, uncrewed aerial vehicles, UAVs, and electric vertical takeoff and landing passenger crafts, like flying taxis.
And think about the computational nightmare of integrating all those autonomous, uncrewed drones into the exact same localized airspace as traditional manned 737s. It's staggering.
You can't just have a guy in a tower with binoculars managing that.
Exactly. Legacy radar and human air traffic controllers cannot manage a swarm of hundreds of low-altitude drones operating in urban or semi-urban environments near active flight paths. It requires an entirely new protocol of automated, localized air traffic management.
They're effectively becoming the air traffic controls for drones.
Exactly. And TravelSky is perfectly positioned to own that protocol. They already possess the mandate for national commercial aviation routing, so by acting as the primary software developer for these low-altitude cooperative systems, they're establishing the foundational standards.
Wow.
If those pilot programs in Yunnan and Xinjiang scale successfully, TravelSky essentially becomes the digital air traffic controller for the entire drone economy. That is a massive, completely net new industry that simply didn't exist a few years ago.
It's a brilliant expansion of their core competency. They are taking their institutional knowledge of safe, scheduled, high-volume airspace routing and just applying it to a hardware sector on the verge of exponential growth.
That is how an incumbent monopoly prevents stagnation.
But we also have to look at their geographic expansion, because a domestic monopoly cannot mandate foreign adoption. They can't force a European carrier to just use their backend.
Right. Their international growth is actually heavily intertwined with broader geopolitical strategies, predominantly the Belt and Road Initiative.
So as Chinese airlines open new routes into Belt and Road partner nations, TravelSky's infrastructure just follows right behind to support them.
Exactly. In 2025 alone, they executed 147 implementations across 80 overseas stations.
But it's not purely reliant on Chinese airline expansion either. I saw they recently established a strategic cooperation with Singapore Changi Airport.
Yeah, to deploy a self-bag drop platform.
And Changi is universally recognized as one of the most technologically demanding and efficient airport environments on the planet. Winning a hardware-software integration contract in that specific ecosystem serves as a tremendous validator for them.
It proves their technology can actually compete on merit in a highly competitive, non-mandated international arena, which is huge.
Another notable takeaway on their growth strategy is what's actually glaringly absent from the balance sheet: marketing and acquisitions.
They spend effectively nothing on consumer marketing.
Right, you will never see a billboard for TravelSky. And they avoid large-scale, dilutive M&A. They aren't trying to mask a lack of organic innovation by overpaying for flashy tech startups. Their growth is just purely enterprise and government contracting.
Which provides the perfect bridge into part 4, analyzing their actual financial performance through the lens of a mature business model. If we connect this to the bigger picture, what kind of investment is this?
Well, it's categorized in the sources as a Phase 5 capital return company.
Right. And when analyzing equities, context is everything. You cannot evaluate a mature infrastructure monopoly using the same metrics you'd use for a cash-burning AI startup in Phase 1 or a hypergrowth SaaS platform in Phase 3.
Makes sense.
By the time a company reaches Phase 5, the hypergrowth sprint has settled into a steady jog. They dominate their market, they generate massive free cash flow, and the primary objective of management shifts toward maintaining the moat and returning that excess capital to shareholders via dividends or strategic buybacks.
So let's break down that Phase 5 scorecard. The first metric is revenue top-line momentum.
Let's look at it. Over a 3-year horizon, they posted a compound annual growth rate, a CAGR of 18.9%, pushing revenue from roughly 5.2 billion RMB in FY22 to 8.7 billion RMB in FY25.
Green light there. I mean, for a mature infrastructure play, anything over 10% is exceptionally strong, though we do have to intellectually discount that 18.9% slightly, right?
How so?
Well, a significant portion of that CAGR represents the long-tail normalization from the pandemic-era travel collapse. It's a fantastic recovery trajectory, but it probably shouldn't be modeled as a permanent baseline growth rate moving forward.
Oh, absolutely. That's a very fair caveat. The second metric evaluates their leverage specifically, EBIT over interest expense. Earnings before interest and taxes divided by interest expense.
And what's the target there?
The target is a ratio of 5x or greater, ensuring the company can easily service its debt from operating profits. TravelSky clears this effortlessly. It's a bright green light. With only 1.7 billion RMB in total borrowings against highly robust operating margins, their interest payments are functionally a rounding error. They operate with an incredibly conservative, unlevered capital structure.
Which brings us to the cash conversion metric, free cash flow divided by net income. And the benchmark for a healthy Phase 5 company is 90% or higher.
Right, you want to see accounting profits flowing almost directly into liquid cash that can be distributed. TravelSky came in at roughly 86%, which gets a yellow rating in the briefing.
Wait, yellow? 86%? Cash conversion sounds great to me. Converting 86 cents of every dollar of net income into free cash flow?
Yeah.
Why is that a warning flag? Where is the friction?
The friction lies in the capital intensity required to actually maintain their monopoly. Operating national-scale data centers, building redundancy, deploying 5G networks at airports, and training proprietary AI models. All of that requires heady capital expenditure.
The CapEx.
Yeah. In 2025, their CapEx spiked to over 900 million RMB, which was up significantly from the 545 million spent the prior year. That elevated capital outlay drags down the free cash flow conversion slightly.
It's the inherent trade-off of infrastructure. You aren't just pushing updates to the cloud, you're racking physical servers and laying literal cable.
Exactly, and that capital intensity is also reflected in their return on invested capital, or ROIC, which hovered around 14.1%, another yellow rating.
Okay, 14% is objectively solid, but I guess slightly below the 20% hurdle rate you might demand from a pure asset-light software business.
Right. When you are pouring billions into physical hardware and data centers, squeezing out a 20% return on every single dollar of invested capital is incredibly difficult.
But despite the CapEx drag, they still meet the ultimate requirement of a Phase 5 company, which is capital returns.
Yes, they have a demonstrated multi-year history of paying out. They proposed a final dividend for FY 2025 of 807.6 million RMB, which works out to about 0.276 RMB per share, rating yellow oak.
And as a critical watch point, going back to what we discussed earlier, you really need to keep an eye on that 20.8% drop in airport digitalization. If it doesn't rebound in FY 2026, it might not just be a project timing issue dragging down these numbers.
Absolutely. Okay, so the financial engine is robust, albeit highly capital intensive. But we can't look at a state-backed entity without addressing the elephant in the room.
Part 5, execution risk analysis. We've talked about the monopoly benefits. Let's talk about the downside. What could go wrong?
Well, the overall risk level is pegged at medium, yellow, but the core risk, the real red flag, is outside forces.
Meaning the state.
Exactly. This is the defining friction point for any investor looking at a central state-owned enterprise. TravelSky operates under the direct oversight of SAC.
So what does that actually mean for the business day-to-day?
From a governance perspective, it means that executive leadership appointments, capital allocation decisions, and macro strategic directions are heavily influenced by national policy objectives, not necessarily by the desire to maximize quarterly shareholder value.
We saw this manifest clearly in the recent boardroom reshuffle, didn't we?
We did. In December 2025, Mr. Zhang Bo was installed as the new chairman, replacing the outgoing leadership, with the general manager retiring shortly after. And these transitions are explicitly framed in the sources around themes like national strategy and reform and transformation.
So if the central government dictates that building out highly unprofitable, low-altitude drone management infrastructure across remote Western provinces is a critical national security and economic development priority, TravelSky is just going to execute that mandate.
They have to. The capital will be deployed regardless of the near-term drag on ROIC or free cash flow. The strategic timeline of a nation-state is measured in decades, while the timeline of a public market investor is often measured in quarters. That misalignment is the core execution risk.
Here's where it gets really interesting to me, the irony of the moat.
Oh, the paradox?
Yeah. The exact same SOE structure that shields them from competition, giving them a perfect green score for competition risk, is what creates their biggest red risk, outside forces.
The protection and the interference are two sides of the exact same coin.
You can't have the state protection without the state priorities. You cannot buy the monopoly without buying the mandate.
It is the fundamental reality of the asset. Add to that the permanent foreign exchange risk. 97% of TravelSky's cash reserves are held in RMB, yet the stock is traded in Hong Kong dollars, with ADRs priced in US dollars.
So even if the underlying business performs perfectly, a macroeconomic depreciation of the RMB against the dollar dilutes the equity value for foreign shareholders.
Precisely.
Okay, part 6. To survive those macro risks, how bulletproof is the balance sheet?
Well, according to the red flag checks, it's remarkably pristine, 0 confirmed red flags.
Love to hear that.
The cash-to-debt ratio is just staggering. They are sitting on over 10 billion RMB in cash equivalents against just 1.7 billion in total borrowings.
So cash cushion of nearly 5.7 times their debt load.
Yes. If the domestic aviation market suffered an unprecedented multi-year shock, they have the liquidity to absorb it without breaching covenants. Plus, they boast positive retained earnings built over 5 consecutive years of sustained profitability.
And no preferred stock complicating the capital stack. Right?
Exactly. Clean equity structure. And because they eschew aggressive acquisitions, as we noted earlier, there is virtually no risk of massive goodwill impairment write-downs either.
But there is one unresolved mystery from the briefing. One missing data point.
Ah, yes. This raises an important question. The source document points out that they couldn't verify the relationship between accounts receivable growth and revenue growth.
Why does that matter?
It's a classic forensic accounting checkpoint. If trade receivables are expanding at a significantly faster rate than recognized revenue, it implies the company might be extending increasingly generous credit terms to its clients to artificially pull forward sales, or worse, that its clients are experiencing liquidity crunches and simply aren't paying their bills on time.
But the public summary didn't have the notes to the financial statements to actually verify this.
Right. The summary decks provided to investors often omit the granular notes where the trade receivables aging schedule is buried. It's a stark reminder that high-level briefings are merely the starting line for due diligence. You must dig into the fully audited, unabridged filings to ensure they aren't stuffing the channel or masking counterparty credit risks.
Okay, so we have a highly protected, cash-rich, dividend-paying tech infrastructure stock. Is it priced like a luxury item? Parts 7 and 8, valuation, price, and sentiment. Let's check the price tag.
Assuming the receivables aging is healthy, the valuation metrics present an interesting dynamic. At the time of this analysis, the stock was trading around 10.5 to 11 Hong Kong dollars.
Which implies what?
A price-to-earnings multiple of roughly 12 to 13 times trailing earnings.
For a dominant technology infrastructure monopoly, a 12x PE feels dramatically compressed. I mean, if you look at Amadeus, which provides analogous global distribution and IT solutions for carriers primarily outside of China, they historically command a significantly higher premium.
They do. And even TravelSky's own historical baseline typically floats in the 15 to 22 times earnings range.
So it's historically cheap.
Yes, but the market isn't necessarily mispricing the asset through ignorance. It is applying a calculated China SOE discount.
Meaning investors are pricing in those execution risks we talked about.
Exactly. Institutional investors factor in the governance risks, the potential for suboptimal capital allocation driven by national mandates, and the RMB currency exposure. That 12x multiple reflects the market demanding a higher risk premium for the governance structure.
But at that valuation, the dividend becomes a very comfortable buffer while you wait for multiple expansion.
It does. The dividend yield sits around 2.5%, but the critical metric is the payout ratio. They were only distributing between 18 and 35% of their earnings as dividends.
Oh, wow. They are retaining the vast majority of their cash.
Exactly. This means that even if earnings remain entirely flat for the next decade, the board has massive latitude to aggressively increase the dividend payout without ever tapping into their cash reserves or issuing debt.
And what's the sentiment around the stock right now?
Well, the market sentiment reflects this steady, unflashy reality. The stock has essentially traded sideways over the trailing 12 months, tracking roughly in line with, or slightly better than, the broader Hang Seng Index.
So it lacks the momentum-driven volatility of consumer tech.
Yeah, exactly. But the analyst community remains remarkably constructive. Bullish, actually. 8 out of the 9 covering analysts maintain a buy rating.
And their price targets.
Clustering around the 12.8 to 13.1 HKD range, which implies a comfortable 20+% upside. Media sentiment is mixed, and investors are generally neutral. The next big catalyst to watch is the interim results around August 20, 2026.
So it's the kind of stock that retail investors ignore because it's quote-unquote boring, while institutional money appreciates the structural downside protection.
Precisely.
But let's throw a wrench into all that stability. Part 9. AI disruption resistance. Everyone is terrified of AI replacing software companies right now. It's the ultimate tech boogeyman of the late 2020s.
Oh, the Suspocalypse.
Yes. The briefing brilliantly titles it the Suspocalypse. The anxiety that generative AI agents will completely circumvent traditional software interfaces. I mean, if an AI agent can directly scrape an airline's database, negotiate a price, and execute a booking in milliseconds, does TravelSky just get wiped out? Do we even need their platform?
It's a great question, but the analysis rates TravelSky as highly anti-fragile in the face of AI disruption. A pristine green rating.
Anti-fragile, why?
The logic is deeply rooted in the mechanics of their monetization. TravelSky survives this apocalypse because they do not operate on a traditional SaaS per-seat licensing model.
Explain the difference.
Okay, if a corporation pays, say, $50 a month for a human employee to use a software interface, and an AI agent replaces that human employee, the software company loses that $50. AI destroys per-seat revenue models. Right. But TravelSky charges a fractional fee per transaction. They don't sell seats. They don't care if a human travel agent spends 20 minutes clicking through a terminal to book a flight, or if an autonomous AI travel assistant books books 100 optimized multi-leg itineraries in a single second.
Because the settlement for every single one of those flights still has to flow through the mandated clearing layer.
Exactly. In fact, if AI drastically reduces the friction of booking travel, it likely increases the absolute volume of transactions. TravelSky simply collects more tolls at a faster rate.
Wow. So they actually benefit from AI taking over bookings.
They do. And beyond the monetization model, there is an insurmountable barrier regarding systemic liability.
Liability.
Yes. The defining flaw of current generative AI models is hallucination, the tendency to confidently invent data.
Right. We've all seen AI just make things up.
Exactly. In the realm of creative writing or code generation, a hallucination is a nuisance. But in cross-border financial clearing and aviation security, being 99% accurate is catastrophic.
Oh, for sure. You absolutely cannot have an AI agent hallucinate a passenger's visa status at a departure gate or guess at the fractional currency conversion for a multi-carrier settlement.
No. The financial liability and the physical safety stakes demand a mathematically rigid, fully auditable, deterministic system. The clearinghouse layer requires absolute ground truth, not probabilistic prediction.
And that ground truth is anchored in the physical world, isn't it?
It is. TravelSky is not merely lines of code residing in a cloud server somewhere. They are physically integrated into the concrete of the airport.
The hardware we talked about earlier.
Yes. They operate the RFID baggage tracking networks across more than 90 airports. They manage the private 5G communication nodes at 160 locations. They process the biometric facial recognition data at 52 terminals. An AI chatbot, no matter how sophisticated its reasoning capabilities are, cannot simulate the physical routing of a suitcase through a subterranean carousel system.
Right. The physical integration creates an unbreakable data gravity. When you control the hardware choke points, the software layer becomes utterly undisplaceable by a pure digital entrant.
Therefore, the real long-run risk, the only legitimate existential threat to TravelSky's dominance, is entirely non-technological. The threat is policy.
Meaning?
An AI startup won't unseat them. But a stroke of a pen by the central government deciding to dismantle the monopoly and open the aviation IT sector to domestic competition, that would. Their moat is regulatory, and therefore their singular vulnerability is regulatory.
It all circles back to the mandate. It always does with these SOEs.
Always.
So let's recap. Synthesizing everything we've pulled from this extensive briefing, TravelSky represents the invisible, indispensable nervous system of Chinese aviation. It sits firmly as a Phase 5 capital return company.
Meaning it's mature, highly profitable, sitting on a mountain of cash, and unlevered.
Right. It operates a state-mandated monopoly, deeply integrated into airline ERPs and physical airport infrastructure, rendering it practically immune to traditional software competition and the AI apocalypse. But investors must price in the reality of the SOE structure, where national strategic whims and mandates will always supersede the singular pursuit of shareholder return. And they have to acknowledge the persistent drag of heavy infrastructure capex on free cash flow.
It is the quintessential study of utility-like infrastructure disguised as a technology company. The barriers to entry are absolute, the revenue is tied to macro-human mobility, and the governance requires a very specific risk appetite.
Which leaves us with a truly fascinating macro scenario to consider before we go. We spent time unpacking their pilot programs in the low-altitude economy, right? Building the software to integrate drones and flying taxis into traditional airspace.
Yeah, the UAV cooperative system.
Well, if AI continues to remove all friction from autonomous flight, we are going to see an explosion in the sheer volume of uncrewed aerial vehicles.
The sky will be exponentially more crowded, necessitating an entirely automated algorithmic approach to air traffic control.
Exactly. And if TravelSky perfects that low-altitude automated management protocol domestically, and then leverages the Belt and Road Initiative to export that standard to emerging markets globally, we might be looking at a company that transcends its origins.
That's a profound thought.
Right. What begins as the IT backbone for human travel in China could quietly evolve into the foundational invisible air traffic control protocol for everything flying in the sky across a significant portion of the globe.
The data gravity and physical infrastructure they are building today creates the perfect launch pad for exactly that kind of standard-setting dominance. It is a long-term strategic possibility that goes far, far beyond processing airline tickets.
It changes how you view the airspace. The next time you walk through a terminal, check a bag, or just look up and see a drone charting a path over a city, take a moment to consider the digital concrete holding it all together. The most powerful entities in the world aren't usually the ones with their logo slapped on the side of the airplane. They are the invisible ledgers ensuring the plane can fly in the first place. Infrastructure is silent, but its power is absolute. Thank you for joining us on this deep dive. We'll see you next time.